And of course, we have option strategies. And for guys who studied options, I want to ask you if it is good or not good. First of all, we see no weekly options, only monthly options. Okay. And so the next option would be until 20th of November. Okay. I didn't put for December options, but straight. Secondly, $2.50 between strike prices. Okay, also not good. We prefer when the difference between strike price is 50 cents or $1. Next thing, look what's the spread. So if we take $20 strike, and the spread between bid and ask, so bid is $1.1 and the ask $1.35. Of course, the market is closed right now, and maybe I just took those screenshots just before the masterclass. It's 25 cents. So do you think it's bad or good spread? I presume whoever trades understand it's not good, right? So it's too much. Preferable spread has to be 5 cents, maybe 10 cents, but not 25 cents. Okay, it's quite high. And similar story with put options. Look at this here, 50 cents and $1.10. So it means if you sell it for 50 cents now and decide to buy it straight away, you would have to pay $1.10. So it's huge spread. Okay, not good at all. Of course, maybe when the market opens, the spread narrows down, but whatever we see now, it's not very optimistic. Okay, now that would be for put options. Imagine the last price. Okay, let's pay attention to the last price. The last price is the last trade which happened before the market closed. So we can see that the trade happened at $1.05. So the share price, $20.21. We sold the put at $1.05. What's our profitability for 1 month? Who can calculate it? Our outlay, like we have to keep on our account $20 and we received $1.05. What would be our profit? Guys who did options, can you tell? 5%, correct, Nick. 5%. So do you satisfy with 5% return a month? If you're satisfied, this is the trade, okay? Because that gives you about 60% return annually. Now, the thing is why it's so expensive. Because the earnings is 11th of November. So this sell is over earnings. You know, you have a higher risk that the price might drop during earnings. If you're happy to own that stock. And now the question for you guys, if you sell this put option at $20 strike price and you receive $1, and then you, for instance, have to buy those shares, the share price below 20, what would be your break even? So $20 minus $1, it's $18.95. And look, if we pay attention to whatever you told me before, practically every one of you is happy to buy at $90 or above. So so at this level, so that would be our break-even point. So by selling put with this particular company, even at current levels, you're bringing your share cost to $90. That's the power of selling put options. Now, you still need to sell it when you see it drop down completely, start turning around. And the reason for that now you're getting only $1, but maybe if you wait until it drops to $90, you might get $1.5 or maybe even $2. Okay, for that. So your profitability will be much higher. Okay, pay attention to that. Now, another thing, let's have a look at our leap calls. Maybe if we don't sell puts, will we buy calls, like leap calls? And let's have a look. I shows here 16th of April, so which is about what? About 8 months, right? And then I look, not 6 months, right? And then I looked at January, okay, close to 40 months. Now, if we look at the money, the price is now for options $3.10. So it means 15% for 6 months. Okay, and if we look at $20 here, so it's $4.6, which is probably 23% for call options, to buy any call options. So what do you think, guys? Is it cheap, normal price, or expensive price? Very expensive, correct. Okay, So if we choose the strategy out of that, so what would be the strategy here? One strategy, probably roll, when you buy shares and sell shares, right? Because you can get 10% within Meta for a week. Or if you're not if you're not confident with the level of movement or something like that, and you want a more secure but maybe less profit, you can sell put option, right? And get dollar. In this case, your profit only 5% for a month, not 10% within a week, but 5% for a month. But you bring in the your average cost of the shares straight away dropping down. So it's kind of secure, and then you don't have to pay attention too much to the market. You just solve the put, close the computer, and then do whatever job you're doing. All right. So definitely not working buying leap calls. Too expensive. Okay, we don't buy it. Maybe after the earnings pass, maybe the volatility drops down, and at that particular time you might consider buying call, but not right now.